First of all, thanks, Mark and the organizers for the invitation. I was also very pleasantly surprised by the beauty of Arequipa, a city that I didn't know before. When Mark asked me to talk about this topic in particular, I realized that I haven't written or thought anything about this in the past 4 years or something like that. So this entailed some refreshing on my side. And I started reading, most of have been written, and particularly the recent pieces, both journalistic, some from the Bank of England. The IMF also produced a couple of papers based on which I think Mr. Lin's presentation was prepared. And let me tell you, my impression was that many things have been done. I think it's not that this discussion has been dormant for 4 years, yet some of the key shortcomings that were highlighted in the aftermath of the global crisis are still there. Some of the key problems that I used to write about, some of the key obstacles that again reappear in the discussions of the last two presentations are still there. It's like an irreducible stone, irreducible obstacle to move forward with these global financial safety nets. I will try to use part of what Mr. Lins gave us as an introduction, as a starting point, to give it a different spin, given that already we have most of the basics from the previous presentations. I will try to give this a different spin, try to focus particularly on what I think are the obstacles that are still haunting us when we want to move forward. So let me start by some definitions. This is essentially going back in a much more rudimentary way to what Mr. Lin prepared. Let me first be very precise of what I think is the topic of what I will be talking about when I talk about global financial safety nets. I think the key issue here is not idiosyncratic shocks, essentially systemic shocks. It's going to be very important when we talk about some of the instruments that, some of the components of the global safety nets, particularly the regional arrangements. So I will be talking essentially of global or regional shocks that have financial contagion, excess volatility, some undesirable features that you would like to prevent by implementing these safety nets. And the components of the safety nets, again, following Mr. Lin's presentation, are essentially these four blocks: reserves, self-insurance by the accumulation of international reserves, which, by the way, are not only accumulated because of self-insurance. I do believe that much of this accumulation was a result of leaning against the wind, sterilized intervention to prevent appreciation and depreciation by the central banks. But as a side result, you have a large stock of reserves that ultimately work as a self-insurance mechanism. Then you have the bilateral central bank swaps, which I separate from the regional arrangements because these bilateral swaps tend to be closer to what I think of a facility rather than a regional arrangement that typically requires some conditionality and some application process. And this, as we will see in a minute, is essential to this discussion. Then we have the regional financial arrangements, which can be a reserve pool like the Latin American Reserve Fund, or a network of central bank swaps, like, for instance, the Chiang Mai initiative. And finally, we have the IMF, and within the IMF, we have this menu. Some of the IMF officials here will correct me if I'm missing something, but essentially are variations of this credit line that was implemented during the crisis, right after, in the midst of the crisis, that has the advantage of being more straightforward and pre-qualified, so you don't need to go through the motions as in a typical IMF program, but still needs to be requested, and that's where the stigma, even for large countries, even for countries that are pre-qualified, comes into place. Countries have to request the line. It's still not a facility, right? And I think this is important to keep in mind. And then we have, alternatives to this flexible credit line for countries that are not that systemically important or that don't pre-qualify to the more generous FCL. The FCL, among other things, have no cap and is closer to automatic. It doesn't entail any corrective action exposed, as some of these, for instance, this precautionary liquidity line might require. So this is the menu, and the objectives, as Mr. Lin said at the beginning, are three, essentially. Crisis insurance, that is preventing the crisis, and that's where the facility, the nature of the facility comes into play, more importantly. Crisis mitigation is providing finance during the crisis. That means you can't prevent the crisis, but at least you mitigate the effects. And a third objective that I won't be talking a lot about, because I think Andrew Powell will dwell more in detail into that, which is provide good incentives to avoid moral hazard problems. I'm not a big believer in moral hazard problems in this context of external shocks, exogenous shocks, but I'm aware that this is a key issue, so I will leave that for Andy Powell to elaborate on. Well, I will try to make my point on the differences between these first two objectives, crisis insurance and crisis mitigation. And here, words are curiously appropriate, because we're talking about safety nets. So essentially we're talking about an arrangement that doesn't prevent the fall. It mitigates the impact, but doesn't prevent the fall. So most of these global financial safety nets are successfully mitigating the effects of a crisis by, for instance, financing, providing liquidity in the middle of a crisis, but are not that successful at preventing the crisis per se, itself. So we can think of this as a safety belt. The car crashed, but you're not dead, but the car crashed. And the idea is, if you have a facility, like a central bank facility, you prevent the crisis. So what I think is important is to focus on the first objective, which is the one that I think is most of the time missing from this whole, this overall global financial safety net program. Okay. So what can we say about the scorecard, the evaluation of how this works? As I said, much has been done. There are many new facilities. There is a lot of money on the table, although still that money dwarfs against, when put, compared with international reserves. This was a very, I think, eloquent chart that Mr. Lin showed, that at the end of the day, in terms of the sheer size of the safety net, is reserves that dominates. Ultimately, particularly in big countries. Hold on. Okay, here, sorry. So how do we evaluate this global safety net? Well, let's take each of these components in order. This is a rather small letter, but I'll try to read them so that you can follow me more clearly. And if you think about reserves, the key say consideration or criticism is that they tend to be costly. Again, here probably I'm not with the majority of analysts in this field, because I tend to think that the sterilized intervention of the purchase of reserves, the cost of purchasing reserves has been vastly overstated, particularly because, as I said before, many of these central banks that purchased the reserves did that as part of a leaning against the wind, counter-cyclical sterilized intervention. So if you actually make the math, unless you have very high interest rate differential, which used to be the case but no longer, the actual cost of purchasing reserves is much smaller than typically sought. There is another counterindication, another criticism or shortcoming of self-insurance, which is, I think, more important in the event of a crisis, which is the bad signaling effect. Reserves tend to reduce the probability of a crisis, but once a crisis starts, selling reserves actually doesn't attenuate the speed. In fact, sometimes selling reserves is bad signaling. We saw that during the crisis. I remember, for instance, having been in Wall Street in the year 2008 and seeing reserves at the Korean central bank coming down. That was a very bad signal, and it was make the market anticipate further deeper crisis rather than the natural thing, these reserves are there to be used. Using reserves is typically a bad signal. So, reserves have played a very limited role once a crisis starts, and that's one of its key shortcomings. I think more importantly than ghost, probably. What are the limits to these central bank swaps? Central bank swaps are the ones that I think are closer to what I would like to see, and I think is missing from this global financial safety net, which is the nature of a facility. We know this, it is there. You don't need to request it. It's like a central bank facility. It's like a lender of last resort. The problem is that, as it was mentioned before, these central bank swaps are selective and discretionary. In fact, we were talking with Andy in the Mr. Lin presentation. I think the central bank swaps, the Fed swaps with emerging economies are expired. I don't think they're still there. They were there as an exceptional measure during the event of extreme appreciation of the dollar. Essentially, that was what drove the Federal Reserve to extend these swaps to emerging economies. But typically, these swaps are limited to developed economies, and there is a huge number of countries that are left outside. So that's probably the downside, the most clear downside of these central bank swaps. Regarding the regional arrangements, I have to go back to when I said at the beginning, if we are talking about systemic shocks, unless I have an issuer of last resort, that is, an issuer of a reserve currency within the regional arrangement, pooling reserves of countries actually are moving together doesn't really diversify any risk. So the benefits are limited. They are very important when there is idiosyncratic shock, when one of the countries is losing reserves or needs some finance, some liquidity, some dollar liquidity. But it doesn't help when the shock is regional or global, which is the case that we are typically interested when we're talking about global safety nets. So again, I can think of the Chiang Mai initiative as a reasonably powerful regional arrangement, because Japan, and to some extent China, but particularly Japan, an issuer of a reserve currency, is inside, and it can actually redistribute, it can actually provide the liquidity needed. But you cannot say the same thing for the Latin American Reserve Fund, which if the region is shocked, will have to resort either to the IMF, to the US, or somewhere else, or to its own stock of reserves. So you're going back to self-insurance. And finally, we have the fund menu, which I mentioned before. And again, the limits there are the ones that were there 4 years ago. There is no facility there. You have to request it. You have to pre-qualify first, so that makes it a little bit selective. But more importantly, you have to ask for it, which implies, to some extent, the stigma of first uncertainty about whether I would be assigned the liquidity I'm requesting, and also the stigma effect of having to go to the fund and request some assistance, something that doesn't happen at the central bank level. Again, the analogy with the lender of last resort, I think, is very important here to capture at least the point that I'm trying to highlight. The central bank, the domestic lender of last resort essentially consists of providing large quantities of liquidity on demand at a high interest rate compared with tranquil times, so that we follow this rule of last in, first out, that typically benefits the central bank. But the important point here is this is on demand against marketable collateral at the domestic level. Given that we don't have marketable collateral at the sovereign level, we cannot give it on demand. So none of these components, and the only one that's actually an exception is the central bank swap, the second one. None of the other components have the same nature as a lender of last resort facility in the domestic arena. And that's what ultimately inhibits the global safety net to prevent crisis. It can help when the crisis appears because it provides a safety net, a cushion. But it cannot prevent the crisis because you never know to what extent you will have this liquidity available, when and to what extent. So, this uncertainty, this unpredictability is still there. And it was part of the discussion 4 years ago. I think still the key missing point. Now, the key question here, because the fact that this is missing doesn't mean it's obvious how to solve it. The key question is, to what extent, under what circumstances, the issuer of last resort would allow unconditional access to its liquidity to any country, even friendly countries. And there is a partial answer to that by looking at the Fed swaps. There are some countries to which the Fed allows conditional in the sense that it's already, on demand access to its liquidity. It's a very small number of countries to which the Fed doesn't actually require an application process or a preconditionality process. But the rest, if you think of the IMF is essentially recirculating, in the middle of a global crisis, recirculating the liquidity from issuers of last resort, from the reserve currency issuers, which are relatively limited, I would say there too, essentially the US and Japan probably at this stage. That's recirculating these two other countries, and it's obvious, it's logical that the issuers, Japan, the US, will ask the IMF to impose certain conditionalities because for the same reason they are not giving central bank swaps to those countries. If the IMF is going to intermediate these funds, it will have to come up with a way in which you reduce credit risk and impose some conditions. And that's where the global safety nets lose the facility nature that's always missing, right? I don't have an answer to this question. I think the answer to this question is there's no way, there's no situation under which the US, for instance, will allow the IMF or any other arrangement to make use of its own liquidity to lend to countries in distress in the middle of a crisis, even if the US is part of the cost of a crisis, even if those countries has nothing to be blamed the crisis for. So in this context, if you look forward, what can you do? You can speculate about a couple of avenues. For instance, you can think that the IMF could borrow, and that's something that actually has been proposed, I think, by IMF itself, could borrow from capital markets and recycle this liquidity, but again, it will still be banking on the international lender of last resort, which would likely limit its consent. It can do something like an IMF central bank combo. The IMF could be a clearinghouse for central bank swaps coming from these issuers of last resort. But again, you need to provide, these issuers of last resort, the reserve currency issues would need to provide the IMF access in the middle of a crisis, which is, at this stage highly dubious. Or you can arrange a combo between the IMF and the regional financial arrangement, something that's been explored as well. The Latin American Reserve Fund, when hit with a global shock, a systemic shock, can go to the IMF and borrow directly from there. And you could actually improve upon the current situation because the Latin American Reserve Fund in particular benefits from the peer control that makes the fund have, for instance, a much better credit rating than any of its members. So there is something to be gained there, but it's still difficult to think a situation in which the IMF would actually lend directly to a bunch of countries without taking into account considerations that are related to the creditworthiness of each individual member of this regional arrangement. But I think these are essentially the three avenues that could be explored to move forward this agenda and to try to mitigate this that I think is the most important caveat of the safety net right now, which is the lack of automaticity. The bottom line, just to close, is that I think that in 4 years we will keep thinking and discussing these issues pretty much along the same lines that we are doing today. We will probably see more minor refinements, and I think that, again, much has been done, and there is a sincere concern about the shortcomings of the existing global safety net. But the situation is most likely will improve, not necessarily because the safety net improves, but rather because hopefully many of the countries that are involved will, because of the lack of a safety net, will move towards reducing their own financial vulnerabilities, which I believe is the reason why this agenda moves so slowly, at least as far as I can see. I will stop here. Thank you.